In the last video, we started discussing revenue recognition. We watched a little bit of New Kids on the Block videos, and we discussed the 5 steps of revenue recognition. Step 1, identify the contract. Step 2, identify the separate performance obligations. Now we're going to continue on to step 3 of the revenue recognition model. Step 3 is determine the transaction price. In most situations, it's going to be easy to determine the transaction price. So, of course, we're going to look at some areas where it's not going to be so simple. What are some things that we need to consider? We need to consider variable consideration. We need to consider whether there's a time value of money component. When I say time value of money, you should be thinking back to Finance 215, financial management. That's what you spent the entire semester doing in that class. And the third component that we need to consider is called consideration payable. Now let's look at each one of these separately. Variable consideration. Well, when we say consideration, typically we mean, what are we going to receive when we have a sale? Typically, of course, it's going to be cash. Variable means that the sales price or revenue depends on some future event. Event or outcome. And there are 2 ways to estimate what our revenue will be when we have variable consideration. 2 methods of determining the transaction price. One is called the expected value method. And this is where we use a probability-weighted method, a probability-weighted amount where there is a range of possible outcomes. You might be having some flashbacks of a statistics class. Don't fret because it's fairly straightforward calculation. And so this is the method that we use when we're not exactly sure what's going to happen, but there are several different outcomes that are possible, and we assign probabilities to each one of those different outcomes. Multiply each amount times its expected probability, add up all the different possibilities, and then that's going to become our transaction price. The second method is much simpler. We use the most likely amount. This is typically used when we have just two possible outcomes. Either we're going to win the contract, or we're not going to win a contract. Maybe there's a 60% chance of winning the $100 contract and a 40% chance that we won't, and our revenue would be 0. We would say, well, the most likely, in expectation, we would say our expected revenue is 60. The most likely amount, we would say, well, there's a greater chance of getting the full 100. We would use the full 100. And this is typically used when there are only 2 possible outcomes. We either win the contract or we don't win the contract. Okay, let's take a look at some examples. This next example is going to be example 4, and if you're looking at your examples from class, Peabody Construction. Hopefully you'll have this next to you as we're working through the video. I've also put them on the slides here. Peabody Construction Company enters into a contract with a customer to build a warehouse for $100,000. This contract has a performance bonus of $50,000 that will be paid based on the timing of completion. The amount of the performance bonus decreases by 10% every week 10% per week for every week beyond the agreed upon completion date. So here we can see that the contract is incentivizing Peabody to finish as soon as possible, as early as possible, and the amount of that bonus is going to decrease the longer they take. Management estimates that there's a 60% probability that the contract will be completed by the agreed upon completion date, a 30% probability that it'll be completed 1 week late, and a 10% probability that it'll be completed 2 weeks late. We're going to use this information to determine the expected outcome, the expected transaction price. Okay, so we know the transaction price is definitely going to be $100,000 at minimum, and there may be a bonus on top. So we need to decide we need to figure out what is the expected value of the $100,000 plus the expected bonus. Okay, so there's a 60% chance that the bonus is going to be the full $50,000. So we're going to multiply 60% times 50,000. We're going to add to that the 30% chance that this amount is going to be reduced by 10%. So this amount here is equal to the 50,000 less 10% of 50,000. 10% of 50,000 is 5,000, so 50,000 less 5,000. There's a 30% chance that the company is going to receive a bonus of 45,000. And let's add the 10% chance that the contract is going to be 2 weeks late, in which case the contract is equal to 90%. Or sorry, it's 10% off each week, so 80%. So we could say 50,000 times 80%, or 50,000 less 20% for the 2 weeks overdue. So 50,000 minus the 10,000, 10% chance that we're going to get a bonus of 40,000. Now we sum all this up. To get the expected value of the bonus equal to 47,500. Now that's not going to be the revenue or the price, so that we need to add the original $100,000 that they're going to get no matter what. We can consider this the guaranteed amount. We would say the expected transaction price is $147,500. That was A, using the expected value method, and B says use the same information and estimate the transaction price using the most likely method. Most likely method is the easy one. Well, we're definitely going to get the 100,000. Add to that the most likely bonus. There's a 60% chance that we get the 50,000, that we finish on time. So the most likely amount is 150,000. Done. Answer to A, the 147,500, and the answer to B, 150,000. Okay, so let's go back up here. We said determine the transaction price. We consider the variable consideration, and now we're done with that. The other thing we need to consider, number 2, the time value of money. Okay, so we're asking ourselves, is there a financing component in our contract? Is there implicit interest being charged? If so, we need to strip out that interest component. We recognize the non-interest component once we provide the good or service, and that interest component should be recognized over time. over time or as time passes, which means there's going to be an adjusting entry at the end of the year to recognize the interest revenue portion. Okay, let's go to our next example, example 5. We have this here on our class examples, and I have it, and then hopefully not in a better format. I have it here in our class examples. On July 1st, 2019, SEK Company sold goods to Grant Company for $900,000 in exchange for a 4-year, 0 interest-bearing note with a face amount of $1.416 million. The goods have an inventory cost on SEK's books of $590,000. Here's the question: how much revenue should SEK Company record on July 1st? So the sales price is $900,000, but we know that the sales price is $1.416, but that includes the fact that the customer, Grant Company, is able to pay over 4 years. So the difference between what they're selling the goods for and what the amount of the interest-bearing note is, that difference is due to interest. That interest can't be recorded, so revenue will not be the 1.416 on July 1st. The sales revenue is going to be equal to the 900,000. So you're probably thinking right now, well, how are we going to record that 1.416? So what is that right to receive? So SEK has the right to receive 1.416 million in the future. What do we call that? If you said accounts receivable, you're very close. It's a more formal amount, which includes interest, which is a notes receivable. This would be considered a 0 interest-bearing note receivable. We record the sales revenue for the 900,000. And the difference between the amount of the note receivable and the sales revenue, something related to interest. We haven't covered this before, I don't believe. This difference is called discount on notes receivable. And that's because this is a 0 interest-bearing notes receivable. That interest is implicit in the note. So we just plug the difference to this discount account. And then what happens? Well, you can think back to the days of recording the bond at a discount. As time passes, at year end, as time passes, that's when the interest is going to be recorded. Reduce the discount. How much? Well, same way we did this on the bonds. We take the contract amount, 900,000, multiply it by the implicit interest rate, which I did not give you, but I should have. We need to know the interest rate is equal to 12%. I'll try to fix that when I post it up to Blackboard. But you can't work this problem if you don't know that. Interest rate is 12%. So 900,000 of the contract price times the 12% interest rate, and then times how much time has passed, July 1st to December 31st, 6 out of 12. So we have 54,000 on that discount on notes receivable. And what are we going to record the other side of this entry to? What account are we going to credit? We're going to accredit interest revenue. So far we have done 2 out of our 3 factors that we need to consider for determining the transaction price. The third factor, consideration payable, will be discussed in the next video.